This was a challenging one. This is what happens about every 30 or some odd years, whether we need it or not, when feds decide that they need to make changes in our tax code. And so this was a particularly challenging forecast because of the changes they made. We also have an interesting economic climate right now. We have an awful lot of stimulus in a late cycle economy right now, in part because of the tax cuts. And there's a million different ways to look at the change in the forecast. You can look at it on a budgetary basis, you can look at it on a current law basis, a law back then, law now basis. But I think, Tom, any way you slice it, this is an upgrade. It's an upgrade because we had a strong second half, in part because of some of the changes, but because the economy continues to cooperate and we continue to have a reasonably positive outlook on the economy, at least in the near term. As we go forward, there obviously are some moving parts that are of concern, particularly in the area of the corporate tax. And I know that a lot of there's been a lot of discussion about the repatriation of profits and the interaction between, what's due federally, what we think is due at the state level, but everybody's not completely sure. And then there's even discussion about whether or not there may be some disputes after they make some payments in going forward. On the consumption tax side, we had this Wayfair Supreme Court decision, which reversed the Quill decision from '92, which in '92 had affirmed a 1967 physical nexus, Supreme Court decision, which is going to impact the sales and use tax, which now all goes to the education fund, beginning in 2019. We have continued growth in e-commerce, both in the sales and use from the people that have been reporting and collecting and remitting sales tax. Also, we've seen positive things going on in Airbnb. In the corporate tax, the size of the repatriation is still very much an unknown, we think. We got significant revenues this year, but we don't have the details on the returns. These are just payers that have reported that they have profits to repatriate that appear to have made larger than normal payments. And so there's still some discussion about that going forward. And this year, particularly the second half of the year in the final payment season in March, April, May on the personal income tax, we had some significant capital gains events that translated through into significant tax revenues that inured to us. People got their last licks in on the personal income estimates front at the end of December, which we knew about when we sat here the last time, trying to take maximum advantage of the state and local tax deduction before they lost it. So we had a little bit of a bump there, which, from the scheme of things in terms of the way the revenues flow across fiscal years, we're a little bit worried that maybe we got a little forward payment of some of those liabilities in fiscal year 2018 that we might have to give back a little bit in 19. But as you'll see in our reports, there were some significant tax revenue events that happened, not an awful lot of them, that account for the majority of why we were up $65.3 million in the general fund. So
yeah, I think it's good to be here and have positive news for a change. We are approaching a cyclical peak, and I think that's really clear. One thing that stands out when we look at this, cascade of charts that we always present, and you see these, you can pick a chart, it doesn't matter which one, but like the first one on page 3 here that just shows unemployment and virtually any metric you have on the economy these days is showing something that's either close to some record high, record low. These are the lowest unemployment rates in 50 years, more or less. And one of the things, though, that jumps out when you look at all of these is that when you go back in time, and it's always good to look at this over a long period of time, is that it doesn't typically stay at, when you hit some record like that, it doesn't typically stay there very long. Sometimes it goes up sharply, sometimes it takes a little while, or there's, a little bit of back and forth, but it doesn't get much better than this. So it's great that we had the strong revenue we did last year. As Jeff said, much of that's one time or 2.5 time money. In the case of repatriation, that is going to extend a little bit further. And that is complicated, as Jeff pointed out. On page 14, there's a more detailed description of how we went at estimating this. And I don't think that we've ever
Page
done a
28
forecast.
on my report.
Okay.
It's an addendum.
Pretty similar wording, I think.
Copies of yours?
Yeah.
You have
Yeah,
one?
Yeah, it's in
page
town.
14, it has
There's
I didn't have
identical,
this
there's
report.
identical language because we had to run it by the tax department to make sure we didn't say anything wrong.
Yeah, but it's,
No, I didn't put any pictures in.
okay, you want a picture, you have to look at mine.
Yes.
But,
It's a good picture.
the long and short of it is that there is tremendous uncertainty connected with a phenomenal amount of revenue. So we started this process, knowing there'd be money repatriated. The first issue was, does the state of Vermont have claim to that via its corporate income tax? Both tax department attorneys and ledge counsel felt that it was clear that we did have reach to tax that money. And we have been getting payments that confirms that at least some corporate payers also agree with that assessment. Next issue is, well, how much might we get and when might we get it? So we went through just a raft of public information to try to get some idea of what firms were involved, because unless they're firms that are paying Vermont tax, we aren't going to get anything. And we put together a list of 322 companies and started just going through public records to try to set some boundaries on how much money might be repatriated, and then we had got the tax department to run tables that gave us apportionment factors for each one. And so using that, we could estimate what the potential Vermont liability might be. There are two tax rates that are relevant. There's a 15.5% tax rate for cash that's overseas, and an 8% rate for more illiquid assets. And if you assign those rates to this group of 322 companies with the Vermont apportionment factors, you could have an outstanding liability at 8% of about $100 million, and at 15.5%, roughly double that, almost $200 million. So this is a tremendous amount of money for us. For many of these companies, the apportionment factor is so small, Vermont's a teeny little afterthought, but when you add it all up, it's not trivial. Vermont's one of a handful of states, 4 or 5 other states, that taxes the entire amount. And so it hasn't been an issue that's kind of front and center for a lot of these companies, because it's not the biggest part of their concern about the whole repatriation process. But the federal government gives 8 years to bring that money back. And in Vermont, the opinion of the tax department is that it is all due for calendar year 2017, and therefore it should happen right away. We're not seeing from the payments we've gotten that any of them add up to what would be 100% of it. And it looks like from, again, the public reporting on this, the companies are developing strategies to take it back in at a pace that maximizes their profitability on it. So there are a lot of unknowns with timing, amount, reach. There have been some information of late that some of the same firms that design these tax avoidance schemes are also trying to figure out ways that it would be exempt from state taxation. And if that were to be the case, if there was a legal challenge and it was determined that states don't have reach to that money, we would then be in a position of essentially having to refund that. So that would either be taken as a carry forward, or a refund could be requested on money already paid. So the way we're estimating how much we've gotten so far from repatriation is by looking at that list of 322 companies. When we get an unusually large tax payment from one of those companies that can't be explained in any other way, and again, we don't have perfect information, we ascribe it to that and we start tallying it. Based on that, we'd say we had between $15 and $16 million in fiscal 18 that we got from that. We already have about $1 million in July. That's not a big corporate month, but it's a non-trivial amount of money with phenomenal uncertainty. We've built in somewhere around $15 to $20 million in fiscal 19, somewhat less in fiscal 20, but it could go, that could all be clawed back, or there could be another 80 million that comes in. You know, I mean, it's that uncertain. And so it's a really unusual situation. We won't know until there are final returns filed and we get a copy of the federal return what taxes were paid that were related to repatriation. In the meantime, we're making guesses based on estimated payments that don't identify it. Tax intends to send out guidance in the next several months that will help clarify it, and that may also give us some idea of whether there's any contested perspectives on it, or there's an issue with the timing of it, and you know how we resolve that is yet to be determined. But it's a lot of money. It's variable. We have a little of it baked in. We've already gotten some, but it's a one-time kind of event, but it's massive potential.
It sounds as though you took a conservative approach to the forecast in terms of what we may receive then.
Yeah, but there's both up and downside. It's not like there's no downside risk.
Right.
So but yes, we tried to be very conservative with it, yeah.
So if we wanted to set that money aside, so that we would be protected in case it was litigated and we lost the litigation or some other state lost it, at the moment we can't identify it.
That's
Is
right.
that right?
That's right.
So we couldn't even do that cautious thing if.
Yeah, I mean, it'd be a best guess kind of
It'd be a
thing.
best
So we
guess,
see a
yeah,
payment and we go
yeah.
back and we say, well, what's normal
Yeah.
for this entity?
Right.
But normal in corporate can be pretty
All over
volatile
the
anyway.
place, yes.
But if there's just a way out of line amount, and these are
Yeah.
big amounts, so you know, that list of 322 companies, if you add up the numbers, it would be $2.7 billion in money that would be coming back. That's close to the total estimates of around, I said billion, 3 trillion.
I thought
2.7
you were
trillion. So it's 3 trillion in estimates of how much is outstanding. So it's big money, and a tiny apportionment factor can sometimes provide a lot of kick. So we get that number back, we look at it, we say we can't explain it any other way, we'll attribute it to this, and that's the best we can.
Are we gonna continue working on trying to identify it?
Yeah.
I mean,
Oh, yeah.
It seemed to me really important to know how much of.
How it's
gets
tracked
paid in
as well,
is-
so that
And we
know
have the
for sure.
technology now to do it that we didn't have 5 years ago.
Well, and their
So-
forms, taxes preparing.
Yes.
The
but-
guidance will help.
Yeah, well, the guidance will help, but then the forms will take a little bit longer.
Yeah.
Because this was a 2017 event from the tax department perspective,
Yeah.
it's like water under the bridge with respect to the forms. But they are gonna prepare a form that will help identify that. So yeah, lots of issues around it, but in terms of how you manage, you know, expenditures that might be reliant on that money, lots of red flags and
Lots of
caution around that.
But our practice in the consensus revenue forecast over time is when you have a change like this, and this is a structural change, okay, that happened, that we deliberately creep up on it so that we don't create a situation where you end up having to refund a lot of money, or you have to end up cutting spending because you built that into the, we've been very protective to be careful, particularly when there are compliance issues like there are. I mean, there may be some companies that need to comply that don't fully realize it yet. So when there's compliance issues, when something's new like this, and particularly when it could represent this big of a number, we'll be honest with you and tell you, well, this is what the calculations raw would tell us. But just like I would never come in this was the biggest spring for final payments in the history of our state from personal income tax. But I'm never gonna forecast that. Even if I thought that was gonna happen, we're never gonna forecast that, because that wouldn't be prudent from the standpoint of you managing and us understanding how the consensus forecast is used.
Well, understand too, the inherent volatility that exists, especially with corporate, personal income, and estate. And we are getting an increasing share of revenue from those revenue sources, and they're being increasingly dominated by a small number of very large payers, and that introduces tremendous volatility year to year. So it's just sort of a fact of both the way the economy is developed and our tax system's reliance on that. And
Actually, I do want to point out that insofar as the corporate income tax versus where we were 7 or 8 years ago in terms of the concentration of payers, we're better now.
well,
We're
not
better.
even
Yeah.
7 or 8 years. Right now, there's a broader base of payers, and it's not as concentrated in a handful as it was just a little while ago. That's to the good, but it's still extremely volatile. One of the most volatile revenue sources, and stuff like repatriation is just layered on top of that, even greater volatility.
And I sometimes joke about it, but I think it's an important message for the emergency board to understand, is that, we always talk about one-time, non-repeatable events. We seem to have one-time, non-repeatable events every year. It's almost like you have to do a forecast of one-time, non-repeatable events. But what was different this last fiscal year versus previous fiscal years was we did see capital gains income come from taxpayers who had capital gains associated with mergers and acquisitions. And that had been something that if you go back to even 17, 16, 15, and then if you go back to 13, remember we had the fiscal cliff asset churning that boosted revenues at that point in time. Though a significant amount of that type of activity, the merger and acquisition activity that resulted in capital gains requirements for people that lived in Vermont, even if they owned the company outside of the state, those were missing. And so that's, I think, what helped contribute to, which for us was a pretty big miss. When it's $60 million on the general fund, that was a pretty big miss for us.
But as you said, those would not have been things that you incrementally forecast, and even though we are forecasting from a base, those were extraordinary events you wouldn't want to be guessing about. So it's better they come in on the high side. We do have, though, a situation where the economy is accelerating. So economic growth is accelerating. It's what you get when you have an economy that's operating at pretty close to full potential output, and you layer on top of that tremendous federal stimulus. So the deficit spending that's happening at the federal level, federal budget deficit is going from $665 billion to just over $1 trillion. And that's providing a lot of juice to the economy right now at a time that it's already close to full productive capacity. So we get numbers in GDP like this 4.1% that came in today, and that wasn't totally unexpected. I mean, you thought it'd be 4 to 5. A lot of that were companies that were stockpiling inventories to avoid tariff charges. So, some of that's going to be kind of one time, but still, there's a lot of stimulus that's occurring in the economy. So we're going to get this peak that's going to be really good. And with that, there will be more state money around in different places. Equity markets have increased dramatically. So there's a lot of potential tax liabilities that exist if there's churning of that occurs, and good things are happening in terms of economic output. It's just that you can't expect that to be lasting forever. We have something of a slowdown in fiscal 21 and 22. So this is not a part of the regular emergency board. I think it's a 2-year forecast, but we do a 5-year forecast that for planning purposes, I would encourage at least a glance at that this year, because it does show you that this is kind of a peak level and is apt to recede. If there's more of a peak, which is a real possibility, if things even surge further than that, there'll be even more of a decline. So you know, that's gonna be balanced at this point. Anyway, that's where we are in the cycle.
We do have a sub-cycle, but the big question going forward is whether or not things that are occurring now are actually moving the supplies part of the economy outward. In which case, we wouldn't have the constraints. There's a whole debate about the non-inflation accelerating rate of unemployment. And we went through that last summer, and that usually is about 3 years before we have a recession. But then some people are arguing that, well, maybe that rate is a dynamic concept, it's moving, and the estimate is that it is too high, and that we really haven't gone through it yet. And some of that's driven, you know, by the fact that, well, maybe we're not using as much of the capacity of the economy because there's been some capacity sitting on the sidelines, and now it's starting to come back in, and by way of some of the labor force. So it's not a precise world. And the argument by the people that were in favor of late cycle stimulus was that we need to do something to shake the economy out of where it is. And if we combine that with things like the deregulation that's going on, and we do that with enticing people to come back into the labor force that are on the side, then we actually could prolong where we even are now, where if we are sitting here a year from now talking about the economy, we're probably going to be talking about the longest economic upturn. Forget about peacetime, forget about post-World War II, ever in our history. Well, since we've been recording economic history, and that would be in 1854.
Yeah.
So, to reduce all this to sort of basic terms is, we are doing a forecast change. You're both in agreement of $33 million for 2019. Out of that, you're saying it's tremendous uncertainty because maybe if you look at 1832, about half would be potentially in that one-time bucket. And then overlaid with that is the potential that some of that, in fact, would have to be refunded based on all the uncertainties that you've rolled out. So as we're looking ahead, we shouldn't say, well, we've got $33 million more to spend, because in building a base, because that really probably would not be prudent to do.
I think we think there's more money. This is done on a budgetary basis, so that I only do revenues, I don't do spending and that kind of thing. So I think there's more money to spend. I don't think there's a tremendous amount of more money to spend.
More than the 33?
No, more money than when we sat here the last time talking about what was available from revenues for 2020, 2019. Okay.
Upgrade is the
You know,
33.
so.
Yeah, the upgrade is the 33.
Yeah. So, you know, so in that respect, it's an upgrade. And we have, I think, appropriately incorporated in the risks, everything from, you know, there's still some difference between